Good morning. We are holding this session. We've called this session a case for conviction. Now, the idea here is that generally what I have observed in the past, that the human sentiment is the biggest indicator of how the market is. So I still remember back in 2024, I was attending an Independence Day party at a friend's place. Everyone wanted the next, small cap multi-bagger out there. At that point of time, I was talking about gold. I was talking about, moving away from equities. And people didn't like that. People would rather just send me away. So people would just rather send me away, and, they were not, nobody was interested in not listening about equities. Similarly, just recently when I had gone somewhere, once you start talking about equities now, people are more likely to throw you out of the place. So that's the basic understanding. The human sentiment is the basic understanding of how the markets are. And that's what we've realized over the last 1 month. We've got a number of queries, as to why are we bullish? Why we keep remaining bullish? When is this gonna end? First and foremost, before we begin this, we're not war experts. We'll not talk about the war. We don't know how that war will end. But we can read markets, we can read sentiments, and that is what we'll focus on. So before I just begin, just let me share the screen. Again, as I said, that today's session, we're calling this as a case for conviction. Today's market looks very much similar to March 2020. Why that is not in memory of a lot of people in terms of why it doesn't look like that, it leads to a lot, because the number of participants right now are way too many than what they were in 2020. 2020 felt like the end of the world. You'd got a number of news channels, experts calling that probably we'll stay in our house for the rest of our lives. The conviction was just not there to go into those corrections. So again, what we are saying that last time around, the last session that we had, we said that oil does not ask for permission, so do corrections don't ask for permissions, but also recoveries also don't ask for permissions. Recoveries post a event are generally very sharp, very fast. So what we have done, how we've structured this is a 3-case chapter, as we always do. The first one being reading the room. We'll read as to what are the sentiments saying today. Second chapter, we'll put our own case for conviction and leave it out for you to figure out that, whether it's enough reasons that we can give as to maybe build that conviction. And finally, we'll tell you about our positioning as to how we are positioned and based on what we are looking at. Just quickly before we begin, it's been read all over. Across the world, March looked like a bad story, bad movie, horror movie rather. But if you look from a longer term time perspective, Indian mid caps, Nifty mid caps are still outperforming the rest of the world. We continue to do well in the longer term. We've had massive large bull run in the last 5 to 6 years, and that shows in the long term picture. However, when you just keep a very short term vision, obviously India has been the laggard when we compare it to the rest of the world. Across China and US, we kind of see ourselves way behind in that picture. This particular difference, this kind of divergence is basically an opportunity for us rather than being scared about the whole picture. Again, when I look at in terms of fundamentals, since we've begun this particular series of market action pulse, this is probably one of those places where we've not seen many greens. Obviously, oil has kind of gone ahead and dampened the fundamentals across the world, and it comes as no surprise as such. And that's what you kind of keep reading across news. PMI for India at 56.5 is the lowest since when we began, since quite a long time. We've seen 61, 62. PMI being the Purchaser Manager Index, which a number above 50 tells you that we are expansionary. A number below 50 is contractionary. We still continue to remain the highest PMI country in the world among the major economies. GDP growth wise as well, India continues to be the fastest growing large economy. Our inflation has ticked up quite a bit. We've gone from, I think, 0.7 to 3.2% in no time. It was expected when we said out 0.7%, we said the base is just too low, and that base effect can now start coming into picture, and you would kind of see larger numbers as well. It was kind of an anomaly that the country was growing so fast without inflation kicking in. Now this scenario, these kind of particular numbers look much more better rather than a country growing at 8% with 0% inflation. That it's hardly possible. It was possible for a short period of while, but this now kind of looks like a normal scenario to us. A country growing at 7.8%, having 3.5% inflation is a decent place to be. And there are a number of concerns with these kind of numbers as well. So let's just read the room itself. The first concern as such, any kind of webinar, any session on investments right now, if we start without oil, that would be kind of, not great in terms of, it would look like an outlier. So let's start with the oil. Oil is at between $100 to $115. The street says inflation, and so are we saying. We've continuously told you that we are moving to an inflationary world. We are moving to a world that would become way more expensive. But we believe that oil may not be the reason why inflation would kick in. Why do we think that? First and foremost, if you kind of look at oil from a very short-term perspective, from a month or so perspective, then it does not affect inflation at all. So the first and foremost thing is that the duration matters much more than price. That is what history tells us. So let's look at what the history tells us. What we've done is we've taken three previous runs in oil. So basically these are the times that oil went above $100, and we've tried to figure out that how long the oil stayed above those 100 levels as well. So the 2008 crisis, post the 2008 crisis, you had oil above 100. That was when the peak price of 146 was achieved. Between the 2011 to 2014 run, oil went to $126. In 2022, when the Ukraine-Russia crisis happened, oil went to $127 or $128. The longest streak again is the 2011 to 2014 period, where oil was, after the Arab Spring, oil continued to remain above $100 for quite a long period of time. The number of trading days above oil again is between that 2011 to 2014. So what we've done is we've kind of plotted oil. So blue line is basically oil. The red line here is basically your inflation. So when we kind of look at oil, a spike up in oil hardly has translated into a spike up in inflation for a long period of time. So that's what we say, that when in the 2011 period, when oil hit $100, we've not taken the 2008 period, because 2008 period or between that 2007, 2008, we just got hit by a crisis. So there's no point you looking at a recessionary environment. Obviously your inflation would have ticked down. So the better way to look at this is 2011 and 2022. So 2011, when oil spiked up and continued remaining over $100, there's hardly been any translation into inflation. Inflation did tick up from starting at 9.5% till going to 9.8%. It did eventually go to 12%, but it was way afterwards. So till 2013, we continued to remain in this period. And in 2013, you had a 12% inflation in India. Similarly, when we look at the 2022 crisis, when there was Ukraine-Russia conflict happened, you started at 6.07. The CPI peak, this is over here. You had this small period in which oil went above $100 and it came back again sharply. In that small period, the translation happened in terms of when the conflict started, we were at 6.1%. We went to 7.8%. The change was around 1.7%. The lag between the start of the oil being at $100 to translation of CPI reading coming out, the lag was around 2 months. So this time around, we're starting off from a low base, 3.2%. Generally, when we're starting off from a low base, you would expect a bit of higher inflation as well going forward. So we expect inflation to be obviously, if we translate the same 2022 to 2026 and say that, let's say it's a 1.8% inflation change, then we are looking at numbers around 5% of inflation at this stage. There are other factors as well which will change the inflation number. So, um, and those factors, and as I said at the beginning of the slide, that oil we don't think will be the only reason kind of trying to. We've seen that oil does not change inflation too much. 0.3 and 1.8% is not that big a number. So what could drive inflation this time around? We believe that this time around it's not just oil, but the replacement to oil, basically metals. We're trying to move towards a world which is renewable, and metals this time around find themselves in very short supply. So things like aluminium, steel, copper, all of them are supply constrained at this point of time. When you put both of them into the cocktail itself, it kind of becomes very explosive. So, so will there be a second inflationary wave, which is after your COVID time? You thought that we've seen a period of high inflation. Should that repeat again? We think it would, and inflation is a thing that one has to be genuinely worried about, and we'll show you how we are kind of looking at it, at what probability and what percentage, and how we're kind of placing ourselves for it. In that regard, the other concern that we hear is basically Fed is trapped, and that's kind of, they've got nowhere to go. Across the last 2 years, they've been trying to figure out how to bring down inflation. The inflation sits at around 2.7% for the US. They've tried hiking rates initially, then they've tried cutting rates, and now they're trying to hold rates. None of that is working. So there are actually no good moves left for Fed. Given that we believe that Fed would kind of start hiking or holding, either one. So let's say if they hold, the growth in US would slow down. So growth in US, which was 4.4% previously, would come down to 1.4. It has already come down to 1.4 within a quarter. If this growth kind of slows down, you're heading towards a US recession, which will be basically a global risk off, and then FPIs would kind of sell India, and which generally leads to Nifty downturn. So this is the kind of transmission chain that we're kind of looking at. If there is also a possibility that you have a new governor coming into Fed. He's kind of said that he's agreeing with Trump at this point of time that the US requires lower rates. So he's agreeing to it. Let's say if they cut too early, that gives a push to inflation straight away. The bond market will definitely revolt. The day watch kind of cuts interest rates, maybe the first major reaction for US 10 years may be downwards, but within no time, you would have US 10 years would kind of skyrocket. So that's kind of a big risk if they cut too early. So and obviously that will translate into gold, because there will once what is the purpose of US 10-year or US bonds? They are kind of a risk off place. People believe that US has got the military power in the world to be able to protect them. So you pay a premium, or you pay a fees to them. You pay a fees in two way. Basically, one, you have dollar as your reserve currency, and secondly, you pay a fee by holding treasuries on your book. If there is a sell-off on US treasuries, and with the recent events that have taken place, the trust in US bonds will go away. Given that they are sitting at around 40 trillion of debt, also does not help the case. So for sure, gold could spike up. What if they hold for too long? Again, your 10-year spikes up. So in both the cases, your 10-year spikes up, because you would have the world believe that there is inflation coming in, and Fed is not reacting by hiking rates. If they hold it for too long as well, it would kind of lead to a 10-year spike as well. So bond vigilantes will win in that case, and funding costs will also surge across the world. That's the case, and this is a very genuine case. This is one that not many people are looking at this point of time. We've heard a few people look at it, and it's a very genuine case. What we've also seen is that across the last year, what we have done is that we've plotted S&P versus your bond volatility, which is your MOVE index. So MOVE kind of is, think of MOVE index as the VIX for the bond index. So it measures the volatility of bond index. What we did was that when we invert that volatility index, so this is an inverted plot of the VIX index, and we plotted S&P. It's kind of following the same path as your move index. The higher the volatility in the bond index is leading to equities coming down. That means, we think that this is a very genuine case. This is where we believe that volatility will continue to remain in the US 10-year, and that could be a negative for equities. The Fed hasn't cut since December 2025. Their core PC is stuck at 2.7%. The street this year started with an expectation of 4 rate cuts across the year. They're kind of now stuck with probably one, maybe none, given whatever has transpired till now. So every month the Fed kind of holds going forward, the chances of recessions go high, and it would not matter if it's Powell or if it's Walsh. It will actually not matter. We've already seen the US 10-year be the adult in the room. Last year during tariffs, it was the 10-year which spiked up to 4.7%, which kind of led Trump to tackle out. Similarly, we are sitting at around 4.3, 4.4% right now, very close to that 4.7, 4.8 region. Once it starts spiking up, you would see US or maybe US kind of retreat back from the war. It is one of those places. It is one of those instruments in this current scenario that is acting like a check for Trump, and we think that it will continue to do so going forward. Another scenario another thing that we've heard about is that the flows are brutal, and that's because in the last month, the FPIs have sold a record 1.13 lakh crores in Indian equities. When you kind of translate that means that there is 700 crores that is being sold every hour. The calendar year FPI outflow shows at 1.27 lakh crores. What that translates it into is that obviously there is a very high fear in India. We've seen VIX for Indian equities at 25.52, the highest in this particular scenario being 27 or 28, which we saw on one of those days. But what that has translated to is that the weekly RSI has become, so RSI is basically your momentum indicator, the relative strength index. Let's not get into the formula for that, but what it tells you that how much strength the market has. A lower number, a number less than 30, means that the market is oversold. A number more than 70 means that the market is overbought. So number is right now 28. That means that indicates that on a weekly basis, the markets are oversold. What this has also, the selling from FIIs has, what that has got is that FII ownership right now, it has almost a 15-year low, which is 16.7%. So FII has sold every single day in March. They sold around 1.13 lakhs. Obviously, the markets, if this were the markets probably 10 years back or 15 years back, we would probably be sitting at around 16,000 on the Nifty. We are at 22,000 because DIIs have stepped up, because we've continued, a number of people have continued with their SIPs, and DIIs were sitting on a record level of cash, and that has kind of protected the market in this case. But this entire thing needs kind of a flow. So what we've done is, again, when you look at Nifty, this is the weekly chart for Nifty from 2004. So this is almost a 22-year history. The question here we are asking is where the floor is, and probably when you actually look yourself outside a crisis. So if you look outside your 2008 crisis, if you look outside the 2008 crisis, and if you look outside the 2020 COVID crisis, you find that there is probably a floor, and we are very close to it. We'll continue this discussion when we build our conviction case. So this is another scenario that we've kind of looked at. The rupees hit 95. This is what, again, the street is saying. The street is saying that it would go to 100, and there is a doom loop which is alive, and Google knows about it. Everyone kind of searches for USD INR and what is the future of it. So the transmission, let's look at that. So that oil stays above $100, your import bill surge, your CAD, your current account deficit widens, and basically FPIs exit more, and RBI continues to burn to keep the rupee in check. Maybe the rupee kind of breaches 100, and if it does breach 100, effectively, that should not be a very great scenario. So what we've also heard is that RBI is trapped. So they're kind of stuck between two worlds where they have to defend. Either they defend the rupee, they see their forex reserve kind of burn away. The liquidity across what liquidity could be translated into the market goes away in defending the rupee, and growth kind of slows down, which where you are at 7.8% right now, that could kind of slow down. Either you do that or you let the rupee slide, and that means that you are importing inflation. Things become much more costlier. Confidence in the economy kind of erodes, and there is obviously your capital flight risk. Obviously, at $100, we don't expect FIIs to buy it through. We'll see that as well. We'll take that case as well. So right now, RBI has got a cushion of around 700 billion. This is kind of almost very close to the record cushion. Record cushion was probably last year. We are very close to that. They have burned around $70 billion this year to kind of keep the rupee in check. March alone itself, they spend around $15 to $16 billion. The math here is not very hard. If the oil continues to stay above $100 and FPI keeps shrinking, the reserve buffer basically of 700 billion, it will kind of keep shrinking. Right now, the option pricing is saying that there is a 41% odd that by December, we should be at INR 100. Now, this has kind of what we've done is basically we've plotted here the Nifty versus the Google trend for USD INR. Generally, when you have this kind of a scenario where USD INR, people generally don't talk about the currency, but if they start talking about it, they go ahead and search a lot on Google. What happens is that we've seen that what we are seeing is that the blue line here is a plot of the Google trend from almost the last 15 years. Google trend would always take in this particular range. It will always stay between 0 to 100. 100 being the maximum number of times that USD INR has been kind of searched, and then everything is relative to it. The last time obviously when USD INR was searched so much was during the Russia-Ukraine crisis, and prior to that, maybe during the taper tantrum in 2013 is when USD INR I think slipped during the taper tantrum. It slipped in one day from I think around $55 to $66 in single day. I think that was the period when USD INR was surged a lot during those stages. Again, realize that the number of market participants as well in India were way lower back then, also slightly lower in 2022. Market participants are much higher now. So we continue that we start thinking that this kind of trend keeps going up. The red lines here show you the point where the surge has kind of peaked out. When we plot this red line right on top of Nifty, you see that major kind of dips or major bottoms are made when your searches are higher. So rupee being surged a lot helps kind of Nifty as well. We'll continue this case in our conviction case. Now, another thing that we kind of hear is that earnings are being missed and the street is cutting earning expectations across everywhere. FY25 delivered probably one of the weakest earnings since 2020. You had 5 consecutive quarters of estimate cuts. The quarter 2 of FY25 was the weakest quarter, and the estimates have kind of slipped from 18% to 10%, and we are kind of slipping as well. How we are protecting ourselves in this particular scenario is that the places where there is an increase in earning expectation, those are the ones that if you already have a portfolio with us, you know that we are already in those places. So the places where the earnings for the next few years look higher are energy, materials, consumer discretionary, and industrials. Most of the portfolios are built around these particular scenarios or these particular kind of sectors only. So this is where we are kind of placing ourselves in terms of portfolio when we kind of look at earnings estimates. So last time when we were on map, this is what we kind of said. We've said that this will be the year of oil since probably the start of the year as well. Last time in map we kind of put it out more prominently. Oil has kind of done from 69 to 118. When oil does well, we also said that drillers do better, way better than OMCs. That is where you kind of see that across the year, a number of these drillers have done way better. Where we missed out was basically, this is the time that we were last time around in map, and this is what we said. We did make a miss. We thought that this particular demand zone would hold up, so we said that we would go in long, and we did go in higher amounts here. The demand zone between the 23,800 and 24,200, 300 did not hold up, and you had a spike down. You came and tested out the demand zone too, and went up in the middle to 23,800, the lower end of the demand zone. What we did that spike up when we happened, we know that the last time the demand zone which are there last time around becomes a supply zone. So we use that bounce up to basically do the tax loss harvesting for most of you guys, most of our clients. Everyone I think we reached out to when the market was spiking up to do the tax loss harvesting, and added money onto the or pulled out spare cash from there. After the supply zone was tested once more, it obviously has to come down and test your demand zone. So now that it just came back below 22,000 just now, like 21,800 odd. That is when we added back what we had kind of come out on in terms of tax loss harvesting. So that's how we kind of protected. We went long here, probably we lost out a little here. That's fine. That was the risk that we had to take because you don't know how long war would remain. There was a general tendency that this would kind of go back up again, and the risk reward here was kind of way lower. So it made sense to take that particular risk. We did that, and we could come out here in that when the demand zone turned into conviction zone. So we put out every case that we've heard, every conversation that we've had across the last month. Every concern was there. What we did was we took them out. We gave you the entire bear case up front. We've not made our case for conviction yet, and that is where we're gonna go to the next chapter, where we want to tell you that what are we looking at and how is it different than what the street is saying. So different way. This is our case for conviction. Again, we'll start from all of your our rebuttals to what the street is saying, and add more patterns onto it to tell you why we continue to remain bullish as such. The first thing that we heard was basically Goldman says that they've downgraded India's target to 25,900 on the Nifty. We're reading it slightly differently. So what they have done is basically they've downgraded India from overweight to market weight. What that means is that they expect around 14% upside from here. What we're reading is it is actually 14% upside. So right, that's a downgrade, but still there is an upside to it. The GDP forecast has been cut to 5.9% from their previous 7%, which is still will continue to remain the fastest growing economy in the world at 5.9% as well, large economy in the world. The CPI forecast is 4.6%. It is still between the RBI band of 2 to 6%. We expect ourselves, our internal expectations are way higher than 4.6%. So 4.6% for us was kind of a relief. They expect RBI to hike rate by 50 basis points, which is fine. They still have almost very close to 700 billion in reserves, and inflation is around 3.2%. So they still have a lot of room to kind of hold rates. 50 basis points hike will be a very good scenario to be in. Stagflations are in headlines. We believe that from their forecast itself, if you say that the economy is growing at 6% and if the CPI is at around 4.5%, that's not a case for stagflation. So that's just an exaggeration of what they're putting up. They say that FPIs have sold 1.13%. We are saying that FPI ownership is the lowest in the last 15 years. Whenever they have kind of hit a low, we'll continue. We'll put that case forward as well. Things become very different. And they say that Rupee is going to hit the 9500 and going towards 100 stage. What we are saying that when Google trends, we've already shown you when Google trends reach higher. When it reaches 100, I'm sure the Google trend will say that everyone will be searching for USD INR. Those are those places where the last time around, those are the cases when Nifty has kind of made a low. Also, what we did was that when we present this case, the pushback that we hear from people is that, this is Goldman, they've got a number of researchers. Are you saying that Goldman is wrong? We're saying that they're not always right. So last time around, that what we've done is that we've gone ahead, and in the last 10 years, we've seen how many times they have downgraded India. So these are the number of times that they have downgraded India. And what we've done is that from there on, we've seen how the Nifty has moved in the next 1 year. So they downgraded India across the number of times, and every time that they have downgraded India, Nifty has given you a positive return in the next 1 year. So after the 12-month mean return, after kind of Goldman downgrades India, the mean return on Nifty is around 19.8%. Also, I think their research desk and their trading desk is not talking to each other. And on 26th March, they said, sell India or we are downgrading India. On 30th March, they themselves, their trading desk went ahead and bought 93 crores in Indian equities across two companies. So there is a mismatch that they're not talking to each other. They've not always been right as well. The last number of times that they have downgraded India, India's returned over 20% over the next 1 year. So that's a thing to look at. We say that oil is at 115. The fear is real. We've told you the bear case as well. But at this stage, what we want to do is that, again, we've already shown you that the CPI impact in 2008 was 2.3%. The cycle between 2011 to 14 was 0.3%. 2022, you had 1.7% in the next 2 months. Now, what we're kind of doing here is that what we've done is that we plotted oil versus Nifty. So inflation concerns are real. We are telling you that we ourselves expect a second wave of inflation. But when you look at, our concern is more with the market returns rather than inflation, right? We are moving to an expensive world. It's not going to stop it. Nobody can stop that. Your world will become expensive no matter what. We are concerned here as investment advisors, we are concerned around what are the returns that your markets can give when your inflation goes high or there is an uptrend in oil. So what we've done is since 2008, we're plotting here the Brent crude oil with Nifty returns. And what we've done is that overall between 2009 to 2026, Nifty annualized returns are 11.4%. When oil has been in an uptrend, Nifty's annualized return jump up to 20.6%. So oil being higher is actually good for the equity markets. So, higher inflation, we can't stop that, but that translates into higher returns in the market. That is what the concern is. If that's the concern, then your annualized return in an oil uptrend and the Nifty gives a higher return. The actual concern is when oil starts coming down. When oil is in a downtrend, Nifty's annualized return go to 1%. This sounds counterintuitive, but this is how it has played out over the last 15-16 years. If inflation is your concern, then we are not rebutting that. But if market returns are your concern, then this is what we found out, that when oil is in an uptrend, the returns are higher than a normal time as well. What protects us also this time around is that last time we just moved to a new basket in terms of CPI calculation. The food and beverages thing, so maybe we still continue to remain within the RBI band of 2 to 6%. That's a possibility. It will be a tough task, but this is what will kind of push it between 2 to 6%. Food and beverages, which is the major translator into CPI numbers, they generally go higher. So food inflation becomes higher when your oil goes up, because obviously the transportation cost is higher as well when you're translating it into food, and then food prices go up. That basket itself has come down. It can come down meaningfully, almost 9%. So maybe that translation into CPI may not be that prominent. We'll have to see, but there are chances that the new CPI basket may keep the band between or may keep inflation within the RBI band of 2 to 6%. So when oil goes up, Nifty returns go up. When oil comes down, Nifty returns comes down. So again, if the concern is inflation, we're not rebuttaling that. If the concern is market returns, then you have your case right in front of you. People say Fed is trapped and they don't need to cut. What we are saying is that the Fed is pointless at this point of time. Hardly anyone cares. They've already cut, they've already hiked, they've already cut, they've already held. Uh, they have the major reason right now is that there is trust from the major reason why gold has gone up so much is because the trust from institutions is going away. And what we've also realized is that during wars, Fed has a second role. Rather, it is the treasury that has the higher role. So liquidity does find a way. So what we've done is the major wars across the last, first and foremost, let's look at the 2003 playbook. It's turning out very similar to it. So in 2001, you had the 9/11 and the recession. What was that suddenly you had a war in Afghanistan. You had a recession going on, so probably that led to a lower returns. We also taking Sensex because that at that point of time, Sensex was more prominent as well, and it hardly matters, right? The Sensex returns very much translate into Nifty returns. It should not matter as to which index we are picking up. 2002 was when Iraq build-up happened, and 2003 is when Iraq was kind of invaded. The Fed kind of held rates during that particular time, but what moved the market was basically a war budget. So defense spending did go up 15%. Then there was $150 billion plus of war budget. What that did was that lakh liquidity found its way into the markets. Between 2004 to 2007, the war kind of kept on going on. There was it was a low intensity but longer duration kind of kept on going on. And in that period, the total budget for the war became more than 500 billion. And we had probably one of the biggest runs in world markets between 2004 to 2007. What we're looking at is a playbook of wars as well. So during the Gulf War, they had come up there was a 61 billion, US spending in the war. Afghanistan, you had more than 50 billion. Iraq war, between 2003 to 2007, there was $1 trillion that was there in war spending. And these are the Sensex outcomes between those when there is a war. So war brings in liquidity. Wars do not ask Fed for permission. It is more of a treasury call. It is more of a fiscal call rather than a monetary call. So fiscal no more cares about how much we are spending on, and that generally translates into the markets. What we've also realized, we didn't know when we were kind of creating this presentation, but there's news since last night that I think Trump has approved a $1.5 trillion, the first approval being $1.5 trillion, a war budget for this particular case as well. When we look at wars generally are bad for on humanitarian ground, but they generally, the liquidity that is generated during a war gets translated into the market. These are the 1-year returns and 2-year returns post a major war that US has been a part of. This is how Sensex has performed when on our previous wars times. We are probably here. This is the place that you are right now in terms of duration between 0 to 24 months period. We are here. Generally, the trajectory for any war has been on a higher side post this. So the Fed is trapped. Agreed. They have nowhere to go. We're not rebattling that. Whatever action they take now, our case is that US 10 years will go higher. It's something there is no backstop to, right? They can't. They raise, they hold. US 10 year is going higher. They can't stop it anymore. But if the concern is Fed rates, then or US 10 years, we're not rebattling that. If the concern is Nifty returns, then this is how wars have translated into Nifty returns, right? In terms of FPI sold 1.13 lakhs in March, we're asking who is left to sell because FPI ownership is at a 15-year low. Every time, the last time around that last time year that we were here, Nifty rallied up around 78%. So the period, this is what we've already known, that in the last financial year they've sold around 2 lakh crores. March itself they sold around 1.13 lakh crores. In the whole calendar year last year they sold around 1.62 lakh crores. When we were here last time around, the current is around 16.7. The last peak, the current is around 16.7%. The peak that we saw was 21.5% in 2015. The change is higher, obviously. In Nifty 50 as well, the change is basically around 4.6%. This is for the first time that from 2003 that we have flipped to DII is holding a higher number on Nifty than FPIs, and this is the probably the first time that individuals hold higher than FPIs. So what we've done is basically whenever we've taken the years when there was a dip in FPI holdings, and we've seen that what is the 12-month forward return for FPI when there was a dip in particular FPI rates or holding, sorry. So every time that FPI hits a low, the 12-month forward return for Nifty has been positive. So 78% is when in 2010 you had 78% returns. 2013 you had 18% returns. 2020 you had a 120% returns. These are the times that FPIs kind of had a lower kind of the last time that we were here at the same levels. So the red line is basically your FPI holdings, and your green line is basically your Nifty holdings. So the last time around that we were here, from there on, we FPIs have continued kind of selling into India from 2022. The ownership has come down from your 22% to now down to around 16.7%. And during that time, I think from 2022, we've seen Nifty go up till almost the next 2 years, where FPIs continue to sell. So if that's concerned, we think at least you should not be worried about the kind of returns from the market. In terms of USD INR, you have USD INR at 95. The street is saying that USD INR can go to 100. Every time we've already shown you a Google trend chart. Every time there is a panic in USD INR, those are the times that Nifty has made a major bottom as well. So every time that the rupee panics, it panicked at 52 in the global financial crisis. The 12-month forward returns for Nifty was 97%. During 2013, there was a taper tantrum. We spiked up from 55 to almost 68 rupees. The 12-month forward Nifty returns were 34%. In 2018, when there was the EM crisis led by the trade war, you had the USD INR peak at around 74. The 12-month forward returns were 16%. Remember, this was the time when there was actual stagflation in India, and 2020 is when we peaked at around 77, and the forward return for Nifty was 70%. So on an average, when there is panic in the market in terms of USD INR, on an average, the Nifty 12-month forward returns have been 54%. At this point of time, we believe RBI's war chest is probably best that it has always any time been in the past. So having around $700 billion makes us the fourth largest global war chest across it. We've got import covers for 11 months, the strong debt coverage, and we also stepping in and kind of protecting the rupee at certain point of time as well. So again, just the table being translated into a chart, this is the magnitude that we kind of talking on. The average returns for Nifty when USD INR panics is around 54. The times when the returns have been very, very decent. So if the idea is USD INR panic, if that's the concern, then probably I don't think that we should kind of be looking at it in too much details. We could hit 100. The chances at our end from our kind of research table is very low for that. However, if we go there, it just continues to mean that we probably won't go there. The chances are again low. What the risk that we are looking at is something very different, and that we'll present to you in a short time. If your earnings are a concern, that earnings have kind of come lower than estimates, you have had these 5 quarters of earning downgrades, then it is, as analysts, I apologize for every analyst out there, we are kind of, we've always overshoot kind of our earnings estimates. So out of the last 12 years, 8 years is when earnings have taken a cut. Just give me a second. So these are the times that we've taken a hit on. The earnings. So across between FY15 to almost FY20, we overestimated we'd overestimated kind of our earnings estimate. There was a kind of a miss across that time, and from there on, I think every year since from 2021, we kind of extrapolated our negative. Very post COVID, we were almost everyone was negative. We did not realize that the number of the way earnings would kind of go up. So we've undershoot as well. So earnings wise, I don't think in India analysts have got it right. They've either undershooted by a major margin or overshooted by a major margin. So if they are undershooting right now, it does we're not reading too much into it. How we are kind of there are reasons right now why there is an undershoot, or why the earnings estimates have come down. How we are taking care of this, we've already told you. We are actually in those sectors which we kind of believe in, and we've been in these sectors since the last 1 year itself. So right, you've heard me talk about metals since probably 2024. You've heard me talk about energy and other things probably mid of last year as well. So we've taken our framework and gone into sectors where earnings are now kind of higher in that regard. So we continue to do these sector overweights and underweight. We've been underweight IT since, I don't think many of you have ever had an IT name in your portfolio. If there was an IT name, it would have been a consumption-led IT name. That would be just one off. Apart from that, I don't think anywhere we held IT as well. So what we are taking into picture is way more than just the earnings estimate. And if you look at just earning estimates, it is common in India to undershoot and overshoot. We're not reading too much into it anyways. Finally, these are the cases that we want to present you. So our first thing is that just look at this chart. This is Nifty versus the gold chart. Every time that Nifty, there has been a crisis, you have Nifty fall off and gold go up, because in a crisis, that's how things happen. In a risk-off scenario, you have money flow out from your risky assets, which is Nifty, and move into a risk-off asset, which is gold. So every time, these are the yellow dots in this chart. So every time there has been a crisis, whether there was a dot-com crisis or whether there was the GFC of 2008, or whether it was COVID of 2020, every time that we've come ahead and tested that particular level and gone slightly lower than that, these are the purple dots here. Nifty returns post that, or Nifty to gold ratio post that has gone higher. So Nifty has outperformed gold in those kind of scenarios for a time. Generally, the idea here is that the longer the setup takes, we don't have too much history around this. First and foremost, Nifty versus gold. Nifty has a very short history. So we've not been here. We don't have so much history around this particular thing. But every time that we've kind of had here, we've reached this, or we've retested this particular yellow zone. The last two times was within the 2-3 year period. This time around, it's taken 6 years to come back here. Generally, in idea and technicals, what is that? The longer it takes for a setup to come across, the higher generally the post returns are. We're not saying that it will happen right now, but this is a particular case. This is a particular case that you have to look at, that every time that the particular ratio or the ratio between gold and Nifty and gold, whenever it has been tested during a crisis and it has come back and tested it once more, the returns, at least on Nifty, have outperformed gold from a longer term perspective. The number of every time that it has come and tested it, these are the returns that Nifty has given over the next 1, 2, 3, and 5 years. Remember that between 2003 to 2008, there was an entire small commodity super cycle within a whole technology skill cycle. If you attended, or if I've been talking to you for a long period of time, you would know what a technology and a commodity cycle is. That particular period was a technology cycle, and within that we had that small commodity cycle, and during that period you had these kind of returns. Right now we believe we are in a commodity cycle. So the gap is obviously there over the last 2 years. Gold has kind of given you 92% the gap is big out there, Valuations are confirming it. Your RSI is at almost an oversold level. The FPI ownership is at a 15-year low as well. The institution upside for Goldman has come down to 25,900. They are still expecting a 14% upside. Morgan Stanley is at 30,000 almost, so they're expecting a 32% upside. All we are saying is that whenever during a crisis this particular ratio has hit a low, the next time that it has come and tested it outside or in a mini crisis kind of a scenario, you had a government change here, you had a taper tantrum here, you have a war here. So every time it has come up and during a mini crisis, generally the returns have been higher going forward. What we've also noticed that the particular swing just prior to that, the swing high between those two regions, whatever the high has been in this particular Nifty to gold, between the next crisis and this one, this particular high has been kind of taken out as well. We're not saying it could happen this time around. We'll continue to monitor the situation, but that is the level of opportunity this particular retest kind of provides. Another thing that we've seen in 2026 March is that equities and bonds both sold off. So there was no place to kind of hide anywhere. You know, if you would have been in debt or in the debt market, you would be losing. If you were in the equity market, we all know you lost. So in that regard, this is a very special case. What we've done is that we've plotted this particular chart. This is since all months since September 2022. These are the times that particular months both have kind of sold off. So when that happens, whenever there is a sell-off in both the markets, these are the 3 months, 6 months, 12 months, and the 3-year kind of returns from there on. The returns have been generally positive when people have had no place to kind of hide as well. During this period, even S&P kind of returns are decent as well. In terms of when both have a sell-off, generally within a 3, 6, 12 month period, you have kind of a positive return as well. Also, another thing that we've kind of noticed is that since the last 10 years, out of that 9 times, Nifty has kind of made a bottom in the first quarter itself. So when you kind of look at this, for every year, the date of the low has been in the very first quarter, except for in I think 2022, when we were at a high and then you had the Russia-Ukraine crisis. We had a low on 17 June. Rather than apart from that, every time the low has kind of been in the very first quarter. In the last 10 years, 9 times out of 10 years, we've had a low in the first quarter. What followed that post that is obviously the returns. These are the so basically the average 3-month return has been around 13.2%. The average 6-month return has been around 18.7%. The 2022 exception is that you had a June low, and post that you had 19.5% returns in the next 6 months. So generally the average here for the last 10 years has been between 10 to 20%, 22% returns in the next 6 months, whenever Nifty has made a low in the first quarter. Well, should this particular thing happen again, we don't know honestly, but this is the data then that a number of people are not talking about, and a pattern that we've kind of discovered, that the low is being made in the very first quarter itself. That is when I think that is when panics have been larger in that picture. Another thing that I think an analyst came out with and said that Nifty small cap 250 divided by Nifty ratio has hit a resistance, and hence we should kind of come down. Someone asked me whether this ratio makes sense. We use a very similar ratio. We just don't use the Nifty small cap 250. We use this Nifty small cap 100. Why? The 250 universe, understand it is a small cap 250 universe, so it has massive changes going forward. Number of companies come down, number of companies get added. So when we're looking at a small cap index, we want to make it a much more concentrated one, so that there are genuine good companies in that, at least that 100 list out there. When we look at that particular index, this is or that particular ratio, this is how it kind of performs. So we are where we were in 2022 basically, at that point of time. So generally, this is the ratio. This ratio, the floor is at 0. There is no reason that the ratio has to stop at 1. It can go up to as much as 1, but it can't go below 0 because indices cannot be negative. So the low has to be 0. But what we've seen is that whenever this ratio comes down between 0.4 to 0.5, this is when your small caps make a kind of a low. Whenever it has gone above 9.9, between 0.9 to 1, that is where small caps kind of have had a high for a long period of time. So obviously we're not in that crisis scenario. We're not during the taper tantrum. We're not during the GFC, or we're not during the COVID period as well. So obviously this kind of ratio, coming back to these kind of ratios at this point of time, looks slightly unlikely. However, we are at the middle of the ratio. This particular 0.65 level has been kind of a very important kind of resistance in 2022. We've come back and tested it a number of times. So till the time that this particular kind of we above this ratio, generally the small cap universe kind of takes back high. The expectation this time around is obviously that it kind of goes back to your 0.9 to 1 period, and we will figure out when it goes there what is the scenario. I'm sure when it's between 0.9 to 1, the ratio, there will be exuberance in small caps, and everyone will be asking for the next multi-bagger name. So that is the time that I think we'll be in a kind of a crisis scenario. So whenever so these are the ratio numbers, and these are the 12-month returns going forward. This is the current ratio here. We've gone ahead and tested the 2022 resistance. We are still there. We've still not hit the higher resistance mark where the other analysts said that we've hit the resistance mark. We think that the resistance mark is still some bit away. However, all of this, we're not being perma bulls here. We're not saying that this is how it will play out. There are certain kind of risks that we have to manage. These are the risks that we kind of look at, and this is how we kind of will hedge it. What are the warning signs and how we kind of hedge it? Obviously, each one of them we've discussed. If oil remains at $115 and extends on, our probability on that is kind of very low at this point of time. We expect a low intensity, long conflict higher than oil continuing to stay above $115. The difference between these two is that if there is a low intensity, long conflict, then Brent should kind of find a support around 80, 90 or $100, $90, $95. If that continues, that probability we put it at higher rate rather than oil continuing to be above 115. When would we kind of when do we think that this is possible? If your Hormuz Strait remains closed past Q2, why do we think that it is at a low medium thing and not at a high probability? Because there is a backwardation in your Brent futures. What does backwardation mean? Very quickly, that the future prices are lower than your current price. If the difference between your future price and current price is negative, you are in backwardation. If it is positive, then you are in contango. So traders on the oil market, in the oil pit, believe that they're not pricing that high oil in the future. That prices are lower. So we are in backwardation right now. So if this backwardation were to flip to contango, if the future prices of oil were higher and Strait remains closed past Q2, and if the Iran escalation deepens, at that point of time, we'll say that this particular case has played out. In that case, what we'll do is that we continue to remain upstream on your drillers and upstream kind of energy markets. So and the drillers, we'll continue to do that. We'll probably increase our upstream names. We'll reduce import-heavy industrials and probably increase the gold percentage as well. If Rupee were to breach 100, again, very low medium intensity, we're not putting a very high number out there. This would continue if FPI outflows per month continue to remain higher, if FPI reserves fall below this particular number, and the 100 strike option, the implied volatility goes out above 50% in that regard. What we would do then is move to export heavy names. Maybe we start looking at IT and pharma. We'll reduce materials for sure. We'll reduce the metal story. We will have to take a call. It will be a weightage balanced call between supply issues and kind of your Rupee going above 100. And in that case as well, gold goes from 5 to 10%. If the earnings were to cut deeper from now on, this would basically mean that your financials and your energy names, particularly your energy names, do not perform. In that case, we'll reduce there are other parameters also that we've taken into place consideration. In that case, equities, the weightage would come down drastically, the cash will go up, and the filters that we put here will kind of go up way. If there is an inflation second wave, we're putting the probability very high. We've never rebutted the case that where inflation will not have a second wave. We think we are moving to an expensive world. If that happens, what the indicator that we are looking for is that in 2 months time period, your CPI for 2 months should be higher than 5.5%. If your core inflation goes higher, and if food inflation were to return, in that case, we'll change the way our portfolio is allocated. We'll move a lot towards consumer staple and pharma names rather than the way we've made the portfolio right now. If there is a low intensity long conflict, which we think should continue, there will be the Brent would find itself between $80 to $100 or $80 to $90. We'll probably reduce the amount of weightage that we put on in energy names right now. I think energy names would be there within the top 3 in your portfolios. So we'll kind of do that. We'll probably add a little bit of duration risk as well. Rate sensitive, because obviously it will be a low intensity long conflict. That means that inflation kind of keeps going up, your rates kind of go higher. So these are the cases that we kind of think will happen, and the probability and the impact that we put onto it, the signs that we're looking at, and how we're kind of hedging onto it. There are some other outliers risks that we are looking at as well. These are risks that can happen. When they happen, we'll continue to kind of look at it. These are not our base case risk as such. And in short, what we want to tell you is that the foundation, at least the fundamental foundations, are holding. We presented our cases for the reason that we kind of bullish at this point of time. And when you look at the fundamentals, GST had a record 2 lakh crore kind of in the last month. So consumption is alive out there. IIP also has had a bounce back from that previous low. It's last year in this particular same month, it was at 2.9, the IIP growth. Now it's at 5.2. So there is industrial expansion happening. CapEx cycle is intact, and demand is kind of recovering. So fundamentals supported, technicals kind of supported. We presented our cases and the way that we look at every bear case that we've kind of heard out there, and we presented our case. So the panic we feel is priced in. The foundation is kind of holding. So this is how we kind of are positioning ourselves going into the market. What we've done is that we made small changes into it. So China, we've kind of increased the weightage, and we're getting money for China from reducing Japan weightage as well. So given that where we are in the cycle, we are definite that the power is kind of shifting east from the west. And in that case, we are kind of overweighing emerging markets way more than what we are doing in developed markets. In terms of sectors, we kind of reducing weights in. We never held private banks. I don't think any of the portfolios have any quantity of private banks unless you held it previously. We've never given private banks. The reasons or how that has played out is that you probably had problems across all the private banks. We've favored public banks ahead of private banks. We're reducing that weightage as well now. In your portfolios, again, you would have had at one point of time, you would have either 2 or 3 public banks. Now you have only one public bank. That one public bank we are very bullish on. But apart from that, we're not looking at the sector anymore. The reasons being a number of them. We still believe the credit cycle is turning, but it's just at this particular point of time we're finding opportunities in energy, industrials, and others. We would take some bit of time away from. If you understand, this particular fall in Nifty has majorly been because Bank Nifty has kind of not been in the right shape. We would want, similar to IT, we'll continue to keep watching it. We'll continue to see it. And once the structure looks better, once better news comes out, at least in terms of financials, we'll start adding on to it. Instead of that, there are a few months prior to previously, somebody asked that whether we're looking at IT. We said we're looking at it, but we never added a name out there. Why? Because there are opportunities in other sectors. There's no reason to chase a sector that has just fallen off the cliff, rather than that, just waiting for it in terms of improving in shape, getting better news, better, forward indicators that would help us kind of add more names into financials. So we won't add financials in your portfolios or in any of our conversations going forward. We, instead of that, we're looking at autos, and we continue to remain overweight on your infra, energy, metals, discretionary, pharma, and staples, and some bit of reality if it's available in your portfolios. This is the research outlook map that we have. In our annual outlook, these are the sectors we had pointed out. We pointed out on industrials, energy. We pointed out on financials, industrials, energy, metal mining, drillers, consumption, specialty chemicals, and fertilizers. In terms of financials, we trying to move away from banks into other kind of financials. So obviously, in a number of your portfolios, you would have seen that we've added rating agencies, we've added card players, we're looking at AMCs, we're looking at possible capital market plays rather than proper banks. Instead of that, there are opportunities available in certain stages. We've also started adding fertilizers as well in a number of portfolios. Those look like decent plays. In terms of fertilizers, why we kind of adding fertilizers at this point of time? We expect demand to be there for fertilizers. There will be a short supply in fertilizers given what's happened in oil. Also, at the end of March, you had this particular green ammonia breakthrough, which has brought down the import cost from $110 to almost half of it, $51. The number of companies that you're looking at. Also, when oil prices go up, your urea prices go up, which effectively what happens is that there is a shift towards so fertilizers are of two types, nitrogen based and phosphate based. Then you generally see a shift towards phosphate based fertilizers. You would have seen us add phosphate based fertilizers as well in your portfolios. So that's there, and the green ammonia just kind of the signing in on 31st of March kind of just pushes that case. So fertilizer and agrochem is something that we kind of added. This is how we placed right now. So this is where we were on the last time around. We've moved into the next demand zone between 21 to 750. The general idea here is basically whenever this particular thing, this is slightly more stronger than the last time around. This should kind of hold on. Your weekly RSI of being oversold kind of supports that. If this were to break, if any of the things were to happen, we find next demand between 18,900 to 20,020. This is another demand zone that you could, if this were to not hold, we again are saying that this would hold. There are reasons that we provided why we think this would hold. Obviously, between that our previous demand zone between 23,800 to 24,000, that becomes the supply zone. So expect some resistance while going up. This supply can be taken out very quickly just through either a gap up or the way the markets have reacted in between these cases. There have been so many gaps. So either you require a gap up right here, or you require a very strong green candle to take out the supply zone in one go. Else you expect some resistance at least here in this region. And the second resistance is obviously near your all-time high. That's your second supply zone that we kind of looking at. The panic at this point of time tells you to sell. We presented a number of cases why we think we are bullish, and why we presented these cases again from different angles to you. We not selling, we kind of adding on to this particular demand zone. And yeah, that's there. This has been our returns over time. So from first and foremost, we've completed 3 years of managing at LLama Research. We've completed 3 years of managing live portfolios. So this has been the return for us across different risk profiles. Again, during this crisis, you continue to see us not go down as much as Nifty. That is, we've been able to do that because of our positioning in energies, industrials, metals. So these are the sectors we've never run after. We've never run after IT, even though it had a major fall. We never looked at that sector as a value sector. We've been underweight since the beginning of 2025. So again, at this point of time, choosing the right sectors is and looking how going forward it makes sense of the whole discussion and your returns as well. So that's the thing, and that's how we've kind of performed better than the benchmark as well. So in closing, we'd like to say that March 2020 also felt like the end of the world. March 2026 also feels like that. The playbook hasn't changed. We haven't changed either. If you still don't find clarity here, do schedule a call and we can discuss as to particular questions that you have. Thank you for attending. We presented our case in this difficult time. Again, it's very difficult to bring out positive news. We looking at it from very different angles. We're trying to slice and dice reports with news articles from views that are kind of not commonly present, and we've tried to present it to you. We've made our case. Again, it is up to you as to and in terms of if you want to take this, we'll be more than happy to assist you in that. We don't think at least from a risk reward perspective for us, the markets look really attractive at this point of time, but they don't look as attractive, or what we've seen in the past, they don't look. There's no case for kind of leverage at this particular stage. Thank you for attending. Thank you for giving your time today. Have a good weekend ahead. And if you require, if you have questions and require more clarity around, happy to help you out. Thank you so much.